in the SOP creating confusion, uncertainty. I am Dana Hershkowitz of the Dana Company, and this is my podcast, Sweatpants and Strategy. I have two dynamic SBA experts, unfiltered, unscripted, undeniably smart. We have Kevin Rafferty of Paradise Bank, who is the SBA Director, and one of my other favorite people, Michael Johnston of Bankwell, who is also an SBA Director. Today, they share their insights about this chaos. So let's dive right in. Welcome to my podcast. As you can see from my shirt, what a mess. Thanks, guys, for being on my podcast. My first question is, what do you think drove this change? Where are we going? Why do you think this happened?
Michael, you want to go first?
Yeah, and I think what we all understand throughout the years of SBA, things changed based upon administration and the administration's political viewpoint of things first and foremost. So we are always driven by what they push down towards us through CFRs and changes. So I think that's always driving one aspect of it. I think some of the changes are in our industry right now. And we always talk about higher defaults, but I think it's one thing to acknowledge today. It's really, for the first time in a significant amount of years, the SBA has lost money over the last fiscal year and now into this year so far. So I think those are things that are concerning. So I think changes that we had done back in August through October of 23 to today, they felt like were movements in the policy that kind of helped create some of these things. And so I think that they are going back to what we've done in the past.
Fair.
I'll elaborate. I think, Michael, you did a great job, but let's talk about what drives the SBA's behavior. The SBA is a fantastic program, a public and private partnership, if you will. A few decades ago, they decided to put it on a zero subsidy model. So in our $6 trillion spend, they don't want to allocate anything for small business, but they provided a great guaranteed program. So as to the zero subsidy, which means no cost to the government, the SBA has three levers that's going to drive revenue. The first and probably the most important is the guarantee fee that the borrower pays on the front end, which also could be financed. The second is a loan servicing fee of about 55 basis points on the guaranteed portion of the loan, and that's ongoing. And then a third and equally important thing is the SBA will share in a premium above 110. So if you had a 114-point premium on the sale of a guaranteed portion of the loan, they would get half of the 4 points, which is 2. So what's driving the losses? So that's the revenue. Now we're on their income statement and balance sheet. First and foremost, is other than the salaries, are the credit losses. So the last administration did a good job of access to capital, but that access to capital has busted the zero subsidy model. So 80% of all loans written are $1 million and less, and there's no guarantee fee under the last administration. Under this administration, they're putting guarantee fee back. Without elaborating, I'll kind of let you move on, but they are the economics of the program.
So it sounds like, well, I know what the change is happening. From what I understand, and you both know I'm not the expert how you guys are. It's they're going backwards. What they were used to. So what's driving that change with that? Moving forward then backwards, like it's a ping pong match. Make sense?
You know what? I'll take this one first, Michael, and you can grab the next one. What's happened is, with no guarantee fee for $1 million or less, and with the rise of fintech, we have a lot of new players into the SBA space. The SBA's last policy change was do what you do. So, in order to get access to capital, they push a lot of decisions back to the lenders.
Lender.
So these smaller loans, there's no guarantee fee to the borrowers. So the larger loans are subsidizing it with the guarantee fee. And we've had a lot of credit losses. So with that surge, we're going back. We have to take more collateral now. These smaller loans have to pay the guarantee fee. So it's kind of getting that zero subsidy model back where it needs to be. And it's more putting the onus away from the lender, do what you do, to here's what you should do. And we're going back to the old policy. Kind of like the Who song, Meet the Old Boss, same as the old boss. We are going back for the most part to the old SOP.
Back to the
More collateral, more equity injection, and more pragmatism. One key change is under the old SOP, the SBA portal called eTran, they qualified you for the business. They determine eligibility. Now eligibility is back to the lender. So you better know what you're doing or you're going to take some lumps. Michael?
Yeah, I think it's one of those things to your point. They are maybe from an SBA perspective because of headcount, even for themselves, they are now going back and pushing more requirements that the actual lender make the decisions. As simple as, one of the changes that we're seeing is that as a PLP preferred lender, you could choose that, oh, by the way, I'm not really sure if I like this loan, if I'm comfortable with the loan, however you want to say it. Well, we're going to submit it into the SBA for their approval for us through a GP process. They have now pulled that back. So I think to your point, it's the do as you do was just too gray for a lot of people, and new lenders coming in were probably, anytime change happens, sometimes you have to kind of look at what is the driving factor. Is it behavior? So are they trying to change the behavior of some of the lenders out there that got maybe too aggressive, they felt like, or some reason why the defaults were going up? I don't think any of us know 100% of the why, but whatever the case is that, they're looking back to the lender. You need to take responsibility for what you're doing. We expect you to adhere to changes and rules that are going to govern how you lend, and I think some of that is how I look at it from an underwriting, prudent lending practices, they would say. We're going back to rules where, we had a $500,000 loan or less, and you could kind of technically score it. You didn't have to put any underwriting effort or any cash flow analysis. That has now kind of gone away. Even if they've changed the size standard from what they consider a small loan is no longer 500,000, it's 350,000 and less. But even in those 350,000 and less, you're now required to underwrite. I mean, you got to kind of know your management, you got to know the history of the business, repayment ability. So you're putting a little bit more heavy lifting work into the deal, which is getting away from, it's going to hurt access to capital to a degree, but unfortunately, I think it's, what they're seeing is that they've got to find a control mechanism to, drive better behavior.
Mike, I would agree with that, but to add on to your point, the smaller loans, we now have to take collateral, where before they didn't. So that fintech model of here's 250 in working capital, we credit score it, we close it quick, and we're on. It's now a deeper dive into the underwriting, but with the collateral as a backstop.
But I get that. But so Michael, I understand. We've talked about this before, like staffing and how it relates to what you're looking for in a closer, where you do the 500 under with no collateral, and Raf, you're saying that you do it with collateral. So what's the major difference, I guess, in how you go about with these loans, like with these changes? How is it going to impact our industry, or will it?
Well, I think, looking at what the small balance program was doing and kind of where it's going, I think there's a little bit of an unknown right now because one is we don't know how it's going to impact the actual opportunities of loans. Will that slow it down? Just because one is, there is a kind of a gray area, no man's land of who's going to do the 350,000 to what I would deem a $700,000 loan now, because it does require more time. To your point, like if you have a closer and maybe you have to take more collateral, versus, meaning a house, or you have to chase down life insurance, other things, it's going to slow up that process. It's going to take more touch point, even from an underwriter's perspective, being able to say, oh, all I have to do is meet this minimum score and then I can move forward. Or to Kevin's point, if it's working capital, they're kind of restrictive of how you push out. How much funds are you going to decide? You got to put some effort behind this, so there's to me, it's, what I tell people right now, what's going to change internally is the KPIs, meaning how long does it take to underwrite a deal and how long does it take to close a deal? And if you are measuring headcount based upon timelines, now you've got to kind of adjust for that. The other point that I don't think we know is that with the adjustment of, being a small loan, being under 350, you have more restrictions, what you can do with the money, meaning, merchant's cash advance is going to be gone, some other types of requirements with change of ownership that we can discuss. But all of these things may change the actual need in the marketplace. Will it slow down, we getting transactions, in essence, loans that, would have come across our desk and be able to underwrite and do these deals? Now we can't. So I think those are the unknown, how much that will slow the program down in the grand schemes to kind of where we've been for the last 18 months.
There, Raph, what do you think?
I think Michael nailed it. Definitely more time, which will rethink some of the small loan turnover because it takes more time. But in addition to time, it's going to take a little more sophistication. To Michael's point, you have to have a lot more touch points. So a lot of people have a loan operating system. They're going to have to tweak that. They're going to have to do a deeper dive. It all's come down to risk. There's risk to the SBA. The smaller loans are hitting the defaults higher, but there's now a risk to the borrower, excuse me, to the lender, that they need to qualify the eligibility. Did they do it right? And that's how the SBA is going to honor their guarantee.
Well,
So I worry about the new entrants into, particularly in the small lending space. They're going to have to do a little more training, hire a more sophisticated person, and improve their loan operating system.
well, there's two things that, want to, well, do you think that because of this, lenders will stay away from the smaller loans? And number two, with the downsizing of the SBA employees, will it be harder for borrowers and lenders? Well, will it be harder for banks to get loans approved, whether it's small or 500 or 5 million? So you have the downsizing, and then you have the extra work of the lender. So leading into that, do you think that, yeah, are banks going to be doing the smaller loans?
I think they will. I think everybody's going to pivot. I think the SBA is probably the smartest program in the federal government. There's a lot of sophistication there. They've done a wonderful job, but they've historically had about 2,000 employee labor burden, FTEs. It surged with idle and PPP. And now that's gone, they've increased, but that reduction of force, about 40%, is more getting back to the old. That's kind of the theme of this. Obviously, they absorbed the student loan, which is more risk.
Right.
So they're
It's
putting
brilliant.
more on the lenders. To Michael's earlier point, if you're a PLP lender and you have a technical question, they'll answer that question for you. But other than that, you underwrite your own loans. So they want you to get trained. That's where talent comes in. We're going to need more sophistication on the talent and on the loan operating system.
So
But yeah, access to capital is probably my more challenging thing. The older SOP gave us more access to capital and helped small business owners. Now we're just reassessing the risk, and it'll be less access to capital, but in a more pragmatic way that's sustainable. For instance, the merchant cash advances, which is a very high risk thing for a business owner to do. They're the lender of last resort. The SBA will no longer be there to bail them out.
true. Michael, what do you think?
Hmm?
No, I would agree. And, kind of going back to, I guess, your original question and kind of circling back through all this, I think through what I've reviewed personally is that, if you go back and look at the last, 3 to 4 years, who's been the real player in the small balance anyway? A lot of the big banks have been, and major national banks and regional banks have been the biggest players in a lot of times in a lot of this. So I don't think that their model changes. I think it's more the other groups that kind of decided to jump into that space and try to do it. Their their model may or may not work as well as it used to. To Kevin's point, we have to also deal with as lenders, if we are a seller of loans or we a holder. If we sell our loans in the secondary market, then we're seeing less profitability because the secondary market is coming down a little bit. It's then did I model properly with my defaults? So you're going to see some changes just from a pure financial perspective of who takes on the risk. But, you know, the history has always been out there that you have big banks that are constantly in this space, and it's easily obtainable. I mean, the Bank of America, the Chases, the Wells Fargo, US Bank, you know, outside of that, I mean, the small balance was only driven by less than 20 major players that were doing, more than 200, 300 transactions in a given year. So I think those are the ones that will kind of have to reset and redecide. But, throughout my history of doing this for, you know, all the years, most of us have been in the large balance space, so for us, nothing really changes a lot of it. It will change some of the change of ownership behavior of how that's put in there, but I think we'll just see less unit count will come down. The profitability of that's going to kind of decrease a little bit, but that's really a product of the actual lender's income statement, balance sheet for them, and how they manage their risk going forward.
So you mentioned these larger lenders, and so they have this capability of going into this space. And so recently, I've had about, I don't know, 4 or 5 clients basically get rid of their whole entire out of footprint staff. That's one. And only doing loans within footprint. And also at the same time, one client in the Midwest got rid of all of their closers because
Hmm.
they've developed a system where they think closers aren't needed. So, I don't know. But them pulling back, do you think you see this as a trend? Like, what do you think's happening? Because I see it, and they're losing a lot of talent, and I don't understand why they're pulling back.
Well, I can talk a little bit about the economics of, say, the large balance sheet loans and the small. My bank plays in the large loan and real estate category. But when the lenders looks to sell loans, the premiums are off 20-30%, and your labor burden is up 20-30%. We're trying to offset that labor burden with the technology. I don't think we're there yet. I think we're getting there, but it's not there yet. So, the economy's pulling back, you have a little more risk, and you have a lot less reward. So banks are going to have to rethink and get a little more sophisticated. Michael, you want to make a comment on that before I talk to the small business, the economics of the small loan, or?
Yeah, I would say that for the last 3 years in particular, to your point, I've seen a retraction of some of our competitors back to footprint. Some of that I think is driven by liquidity, is my understanding, that they want to be in their space in which they are directly lending and trying to get more deposit relationships along with these loans. So I think that is an important thing to them versus lending money in markets in which they're not part of. So we saw part of that happening up until about 3 years ago. I think, as you said, we're kind of seeing this talent pool issue pop up. I think some of it is, one thing at my institution we are really pushing right now is technology. We have to lean into, how we're going to be more efficient is what we talk about all the time is efficiencies and efficiency ratios of labor to how much income. And then also, of the technology that's out there, can it really serve everything that we're trying to accomplish? And that has continued to be a challenge. And I think one thing that I've learned myself recently is that we talk about all the technology and what we end up doing, but as a lender, if you are starting to grow too fast, it's very hard to lean into the technology because you end up just putting headcount in. Because sometimes you don't have a choice because you're growing, you're putting on more loans, so then you just keep adding in people. Then at one point in time, are you able to make that pivot or adjustment that, oh, hey, by the way, my new technology is great and it works. But to Kevin's point, sometimes that technology is just not quite there yet. It will get there, but I think we're just seeing some people think that, there's a magic sauce out there. Reality is they're not. I mean, we're an SBA lenders. We always talk about we're grinders. We get out there and we hustle every day. We work hard. There's no perfect scenario. Every model, has proven to be successful in its own merit, its own way, but it comes down to the institution itself. Is how I look at it. I always tell people that at the end of the day, there is a SOP, operating procedure of how you underwrite, but every institution, each bank has its own credit culture of how they go about this and how they close loans, how they underwrite. And so there's a change that's always happening throughout the marketplace. So we always have to adapt, good or bad. But that's what makes us special, I feel like. We come in here as an industry, we work hard, we understand what we do, we pivot when necessary, but we're blessed with good people. It's just a matter of how we keep moving down this hill in a very positive way without kind of falling over.
Well, the trend that I'm seeing, going back to your point of software and over hiring, look, there was a top 10 SBA lender that got rid of 20% of their workforce. Of that was the 500 and under staff, underwriters, and closers because they again created a software in which they think they don't need the person. So that's the second time I've heard this, and I'm not, look, it's, hearing this from my candidates, yeah.
Let me take that. I think it's one of those things where what we hear on the street of what's going on with an institution may or may not always be accurate. Because to your point, if it's in a small balance space, yes, is it technology or was it that they are pulling back from that particular product because they've suffered more losses than they anticipated? I don't think any of us really know 100% of what happens there. I think it's just one of those things that good or bad, every bank is a business. We have to kind of take it for what it is at times that, maybe it's a staffing where credit administrator comes in, it's new. Maybe they have a different viewpoint of how things were going and what they were doing. Maybe it is the losses were greater. And this, we answer to stockholders in a lot of ways, not only just executive management. We have a board. And if we're publicly traded, we have expectations. If things aren't going well, then they may push down. So to your point, technology is a good thing. But even in my own knowledge base, technology cannot necessarily today replace the real, high level thinking. We need thinkers. Maybe some of it was the fact that you hired people that aren't thinkers. I have technology that can do a lot of lifting for them, but they still have to be able to know, what I try to tell my closers is that you are one of the biggest points for me that, I can underwrite to a certain degree and I can kind of make sure I'm prudent, but I can make mistakes in the closing or servicing process that could create a repair for me. So we have to have smart people that are actually analyzing and making sure we're getting the right documentation, we're checking off and making sure the audit feature is working properly. And I hope that technology is doing all that. But in my opinion, you still need a person looking at that. Let's make sure that that is, a high level, but that means that that individual has to grow. They can't just be a processor. They can't be just a checklist person. They need to be a better thinker when this data comes in, making quick decisions based upon, because the technology can, I view it as something as green light, red lights, if it's green light, then you can just push it on. You should be fine, but you still need somebody to, have that audit feature. At the end of the day, that's what protects our ability to do what we do in this industry in a good or bad way.
Michael, I would agree with everything, but if I can add on, the SBA's told us for decades we need to do more smaller loans. Here we are doing a lot of smaller loans in a very fintechy way. And the SBA's kind of telling us they're putting up guardrails. You need to slow it down. Let's talk about the economics. We talked about fintech, we talked about economics. zero subsidy, the model's broke. On a $50,000 loan, lenders historically have not made that. With the new SOP, with the new loan operating system, they can. On a $50,000 loan, about a year ago, you could sell at 118, which is an 18% premium on the unguaranteed portion. So for the lender, they had a $6,000, or excuse me, they had a $6,000 premium and they had a $7,500 risk. So their risk reward model is very good. Let's take a look at it from the SBA's perspective. Oh, that's only a $50,000 loan, but people are spitting them out. They are getting about a $1,700 premium, which is half of the premium over 110, but they have a $42,500 risk. And most of that, if that loan goes bad, most of it's just being charged off. So the risk reward is much better for the lender than for the agency, and it has disrupted the zero subsidy model. So the SBA hates to say it, but they're having us walk back the smaller loans, the MCA, which is merchant cash advance, refinance. And that's the reality which we live in, that we can make these loans without costing the government money.
Fair. But with that said, and Michael, I think you touched upon it earlier. What about the trend of, basically I've seen a lot of losses. So do you guys foresee, with the changes, will it help or will it hurt the lender and the borrower with these changes? Will there be a trend in the losses, or you think that with all the changes there'll be like somewhat like of a stop and then an increase? Fair?
Yeah, but I think one thing that you have to be careful of is the data and how you grab that data. We all know that if you are, as an example, if you are pushing a lot of volume unit count up, but then you stop quickly and the defaults are still going up, it actually looks worse. But if you are what you may term, you're outrunning your defaults, you're continuing to put loans on the books from a mathematical equation, it actually could look like it's not as bad. So I think, we're going to see some higher, like you're talking about, numbers are going to continue to escalate, but was it because we're slowing down? Or is it because that the actual defaults are greater? I think it depends upon the data that we pull out and we actually analyze. Because one of the things that, we were looking at, Lumos, as an example, puts out a lot of data from FOIA data that's out there over the history. One of the things that they were looking at is, in front of me, is that the 20 and 2 to 24, you're seeing an escalation of annualized default rates. And it hasn't got to a point where it's starting to slide downward. It's just the line is continuing to go up right now. So the question is, when does it start kind of leveling out? Some of the question is that are some of these defaults, a product of businesses that are really having problems, or was it a product of as a country, we put a lot of money into the economy back after COVID. Therefore, you had, PPP funds, you had idle funds. Was the business owner, getting a little sloppy with their business operations? And so they didn't really manage their bottom line. And so then they got themselves in trouble. Or is it because, we are technically putting on a lot of more riskier loans? I think time will tell. It's much harder to sit there in the midst of this issue to just sit there and say one is always a driver versus the other. I think it's one of those things that we have to kind of analyze over time. But it gets back to something simple. We've all been taught credit analysis, credit underwriting. As a prudent lender, you stay true to, the 5 C's of credit. You underwrite, you do your cash flow. Those of us that have continuously do a good job of that, I think our defaults are within reason, given the economic conditions. We've done well. There's always outliers, no matter what business or banking or whatever the case is, they're always going to be, a little bit more aggressive. And that aggressiveness is, kind of being the forefront of what we're seeing, unfortunately.
But back in February, when we thought that the SBA was going to shut down, a lot of lenders, pulled like as many loans as they could and put them on the books.
Mhm.
So, that was back in February. So you won't know, what's going to, default, go into liquidation. But the fact that like you thought that the SBA was going to shut down is going to create more default.
If I could possibly add on to that, first of all, the SBA's has a very reasonable default ratio. We're putting this in the context, it's increasing. It's increasing to the point where back to disrupting the zero subsidy. So where we are is the history of the SBA is typically defaults have peaked about 3 years after a loan has been made. We went through the 2021, the 90% guarantee, the risk reward, more risky loans were put on the books. So we're seeing some of those defaults run through in the 24 cohort. This new administration, aside from curtailing fraud, they are trying to get more back to pragmatic, more money down, more collateral extended. It's available, more analyzing the working capital and smaller loan model. All those are good and will put us back into a better trajectory, but we're not going to see that for 3 years. So I would probably guess that the default rate, it depends on the economy, but I would guess the default rate would continue to ebb up a little bit. But it
Mhm.
is really not a scary thing. We compare to many bank portfolios.
What do you guys
The
think about?
SBA.
Well, I mean, you're talking about defaults and everything else. I read that they're, with the PPP, EIDL, that's contributing to the default rate. But how do you compare that to 7A? Make sense?
Well, there's a lot of fraud. The PPP, over 95, 98% was forgiven. So the risk came in the idle loans. The idle loans were direct loans by the government. It wasn't made to be pragmatic underwriting. It was made for the survivability of a small business. So that's where government, our government dollars should help subsidize and keep businesses afloat during a very traumatic economic period that the small business didn't happen. They weren't taking on MCA debt. They needed to make payroll to stay open. But there's definitely fraud in that program, and people overreact. Now the SBA's got to really clamp down on future fraud, and there is definitely some fraud in that idle in the PPP
There
program.
was in my last podcast, there were rock stars that requested PPP loans, and they can't like prove it, but there are famous people that that had the PPP for extra business curricular, which I thought was like kind of like over the top. And so,
Yeah, we were approving loans for churches. Around two, we had strip clubs were now eligible. The only industry seemed to be ineligible were the banks were putting out the PPP loans.
do you guys?
So it's profitable for the banks. So all's good. The SBA has done a wonderful job with that program. They could
It is.
have, uh, mind you, this was a Treasury initiative, and the SBA was the driver of it. But yeah, it was helicopter money to put out to keep the business afloat. There was certain fraud, and now we're have the time to put the guardrails up and curtail some future abuse.
Yeah, I mean, it sounds like they're, like, like you just said, you're putting the guardrails up. You have a child, you're flawlessly doing whatever. And then now it's like, all right, they're 2, 3 years old. Let's take the initiative and set the parameters. And it sounds like, Raf, based on what you're saying, moving forward, it's a positive effort from the SBA with these changes. So what do you guys think what do you think that's gonna happen with these changes? Like what's the biggest impact you think is gonna happen?
Michael?
Hello.
Yeah, I don't know that I have a perfect answer for that one. It's to me, I look at it this way, we live in an industry that fraud's always there. We know that. We try to protect for that. PPP was one of those things that, you know, pushed all of us. I mean, none of us were ready to get that kind of money out the door so quickly. And I think there were bad people that took advantage of those situations. But I think that we need to remind ourselves at the end of the day, it was still, there was goodness to it. And I think what we need to just take back from what we've learned through this and carry it forward. And I think that, the SBA is trying to keep that rationale of, holding us each accountable for how we do things. I still say, I came up through credit. So to me, even as a sales manager, and you still take the same thing. You look for what is the right thing to do, the right reason why you lend money, but there's always going to be default because that's the risk that we take and the reason why we lend money. It's a matter of, like I've heard people say that, as an SBA 7A lender, we collect so many documents. If you're really going to go through that much effort to create fraud, we're never going to be able to beat that. But the basics is, to what we talked about earlier, it's as simple as the working capital. Were we just getting working capital for the wrong reasons? And we weren't really controlling that, in my opinion. This is where we go back to, it just gets back into a line of how we've done things for the last 50 years plus in this program. It's just doing right by each person, analyzing, knowing our clients. It's one of the big things too, because, fraud can happen, and it was something that now, because of the way technology allows it, people can come in and do things bad. And it really wasn't the person that was even the borrower. It was somebody who stepped in and, seized a wire or something like that. And things are happening to us, that we don't know. So some of it is, you have to know your customer again. You got to know your business. Little things that the bank regulatory things for us, we abide to every day. SBA just got a little too loose and allowed lenders to do things that we have to go back to just what we know is best.
Like
Yeah, if I can add on to that, I embrace the new SOP. I think it's very wise. I like what the SBA is doing.
Mhm.
Dana, do what you do. If you told that to your young daughter, maybe the grades suffer, the car gets wrecked, and you say, do what I'm going to tell you, you should do. But if you're doing the right thing all the time, the new SOP just makes it more objective than subjective. It crams down a little more risk and a little more responsibility. When I mean risk, it's risk that and you're sophisticated enough to know what the SBA policy is.
Mhm.
So I view this as a more level playing field. And if you're a good player and you know what you're doing, you have a good program within your bank or non-bank, then you'll be fine. And the SBA will be even better. The economic outcome will be better. Mind you, it'll take 2, 3 years to ripple through because uh, bad loans peak in about year 3.
so you're
So be a little
basically
patient on that. It's coming.
so you're back to the 50-10-6, basically.
Yes.
Mhm.
Okay, fair enough. What do you guys think about actually no, I really wanted to ask this question. The franchise list, how do you think that's going to impact, or do you think it's going to impact anything, or you think it'll drive franchises or add to the bottom line? I wasn't clear on that with that because you both know I'm like, ah. So explain it to me, please.
Michael?
I think it's a good thing. I think it got scary for certain lenders because, does this one qualify? Does it not? You need it in a lot of ways, cost wise. You would really have to go out and ask an attorney to review the agreements because you don't want, it was making you in a very uncomfortable place. And so some people didn't have the ability to know yes or no, is this right or wrong? And people need to be mindful too. When you talk franchise directory, it's not just franchises. It is like a fuel supply agreement as an example, things that there's some sort of control feature. Is that entity, that body that is, selling you the franchise have more and pushing more control upon you, that you're not truly the operator in a lot of ways. And I think that's where certain banks kind of retracted to a degree because, they weren't good at it. So they weren't sure. I think it's good because we're just, once again, we're going back to what we're used to. It's more simplified now. It's kind of I look at it as a pass or fail. Either makes the criteria, they're not requiring you to go and get all these updates, that kind of stuff. So I think that there's a lot of positive things that come with this. But I think for us as lenders, it takes another problem out of our hands and say, okay, it's on the list, it qualifies, we can do the loan. It's plain and simple. That's easy.
Okay, so I've worked with both of you in terms of underwriting and hiring, look, I love our business, but BDOs, you both know, are not my forte, and underwriters are more so. So I've heard a couple of stories where, there was a borrower who had no industry experience and wanted to open up, I think it was like a Subway. So how would you qualify borrowers if there's no experience, but they have a ton of cash? So how would you make sense of that? Because it's a good loan, but there's no experience. So how do you make sense of that? Because I've seen that. That's what I've heard lately, where some banks are challenged on, you have somebody that wants to buy a Subway, but they've been a school teacher. But they have a ton of cash. So how do you do that? Like, what happens? Make sense?
Yeah, well, the model for most of the franchises is to try to idiot proof it for somebody who has not been in the industry. So that's not the exception to the rule. That's more of what you're going to see. So as lenders, is it on the franchise registry? We can check that off. Let's look at the strength of the franchise. Let's look at the location. I'm one of the few lenders don't do a lot of franchises because some of them are location to be determined. And to me, the location is half the ball game. You have a great operator and a great franchise and a bad location will fail. If I don't know the location, that gives me more concern than somebody who doesn't have experience. So back to, the scoring model. Somebody could have good credit. They like the franchise and it could score out. But, back to what Michael and I say, the more pragmatic lending, we're going to look at that deal in its totality. Do they have outside income? Do they have post closing liquidity? And let me underwrite the franchise disclosure document, look at the strength of that franchise. And within the state I'm lending, does Subway do well? I'm in Florida. Michael's in Connecticut. Does it do well in our respective states? So, Michael, you want to add to that, or?
Yeah, because I think basically it gets back to what you were talking about first is that even if the franchise is on the directory, you need, as a lender, you need to analyze that franchise. What does it bring first and foremost to that individual? If it's been around long enough and it has enough units, then, they've also been tried and tested because that's the other thing is that if they have limited units on ground, they're what you may call an emerging brand. They're still on the list, but, if they've only had 20, 30 units opened in only in the last 1 year to 2 years, does that create a risk? Or have they been tested? Or are they in multiple markets? To Kevin's point, I mean, I live in Texas, so certain concepts do well here, but they don't do well in Connecticut where my bank is located. And it's interesting, to hear because, each one has, if you look at the FTD, you go in and you see what they have, their open and close rates. They may be opening new franchise concepts, but are they closing some? How many of those have been opened and been operated by the corporation, the franchisor, versus individuals? So, that also teaches you, can an individual come in and get the training they need, which is what we're looking for from the franchise? Or are they going to be on their own? And the only thing that the franchise is really bringing them is a signage and a basic concept, but they still have to go out to the market and sell themselves. Because even like you're talking about a Subway may be one that it's a good location, people come. Maybe they're not necessarily in the best of location, but they're able to go out and get other types of revenue associated with catering or other things, or they're going to the schools or something. So the individual has to be able to be willing to connect themselves with their community. Because at the end of the day, the concept, can be accepted to be okay, but how are you getting your income driven? So the other thing is what we look to is the individual. Have you written a business plan? What are you looking to? How are you going out there? So part of it has to be stages for us of how we look at it. So, but people with post-close liquidity is a good example that it also helps because we all know that people come in with a general concept that, oh, well, I'm going to be break even in 6 months. What happens if it goes 9 months or 12 months and you need additional cash that I'm not giving you? If that individual has cash or outside income, it's easy to underwrite for the risk. So part of it is risk for us in that sense of what do we see? How does it play into this market? And it could be something as bad as they choose a site that really there's things going on, maybe construction in front of them or around them, or maybe there's not enough demographics to really support that concept today, but it works in a larger metropolitan area. But these are back to us as lenders. As long as we address these things up front and understand that, we should be open to give these individuals the opportunity because, at the end of the day, being able to leave your W-2 job and take a risk to be able to open up something like this, the franchise has less, in my mind, less risk in a lot of ways than just saying, I'm going to open up a general restaurant down the street because I like it, but it doesn't mean will the market bear that. The franchise just gives you one more basis of protecting yourself is how it should be. One more level, but it's not the end all.
So are you both trying to tell me that I can't open up a Tiffany store in New Jersey? Is that a
That
no?
sounds like you, Dana.
That sounds like me. So I guess, guys, moving forward, what do you see for our industry with the changes? Do you think that portfolios will increase? Where are they going to increase? And overall, what type of borrower do you think is most, actually, that was a separate question. What type of borrower do you see as, moving forward? Because the last, our last administration, she really wanted to grow the, you know, the, like the, how do I say this? Like women and like, how do I say this? I don't want to say Latinos, but the underserved communities.
There we
She
go.
made a really big push with that. So, do you think the administration will continue on Guzman's line? I guess what I'm trying to say. That makes sense?
Yeah, I'll jump in. As lenders, we are looking just for good deals and the economics of the program to be sound for the lender. So as to the bigger footprint changes, I hate not footprint, but the bigger, 30,000 view, I look for shops to be leaner and meaner. I'd look for them to have more sophisticated talent to analyze this stuff, no longer just credit scoring, better loan operating systems, more AI. And I'll come back to that in a minute. And what is trending now are small working capital deals and large business acquisition deals with no collateral. I think some of that is going to be disrupted. Our bank plays more on the real estate and there's collateral behind it. As a result, we don't take as many hits. So for me, I like being pragmatic and staying there. Circling back on the loan operating system, the limiting factor that we have is we could be leaner, putting in Dana and your company, DH company, one time, and it could ripple through the forms. But now we can analyze your data, no longer putting in tax returns or monkeying those numbers in. We can automate the auto input. But the next wave will be artificial intelligence that we can analyze
I
it.
believe that.
But our constraints for the AI is it's got to be contained within the own cloud. And a lot of lenders just aren't there. In other words, we can't put your financials out in your company out on the web for ChatGPT. So it needs to be contained. It's getting there. That will make the It'll be easier to have an underwriter. We're not getting rid of the underwriters, but an underwriter with less input can handle a higher workload. Same for the closers. So more workload per underwriter, more workload per closer by using more AI and more of a loan operating system. And then the lenders are just going to have to figure out, do these deals make sense, and go back to that pragmatism that we talked about.
Fair.
Michael?
Well, I mean, so I guess what I love about my question is that do you feel with the talent pool out there, the more experienced, SB professionals are going to be suited for this, or would you bring in a green person that you would just, I know, Raph, sometimes you bring up and comers and you train them and everything. So do you think that moving forward, the professionals that have experience will be well versed for that? Or would you rather bring like a younger talent pool, I guess?
I think there's this place for both. The more sages that have that sophistication, they should bend their salary upwards based upon their sophistication. And we always have to introduce new people, talent. Banks have less training programs, as you know, and that's ergo we have a dearth of young talent. But I've been monopolizing. I'll let Michael weigh in on this.
No, I think you're right there. I think, we all would like to kind of, we are unfortunately an industry we're kind of aging out. Bringing in young talent would be great, but sometimes we are busy. And so bringing in somebody with experience is easier than trying to, and Kevin's point is, it's training. We lack training sometimes to have time, so these younger people we bring in, but we throw them into the fire and say, okay, good luck. And then if they're strong individuals that can kind of learn quickly, they grasp hold of this and they do extremely well. Those that really need more time, because I think the other thing is that we have also become an industry where we're not centrally located anymore with the back office. A lot of us, me in particular, my team is spread out throughout the country. So doing something or being a part of something through Zoom or, not having some knowledge base through osmosis, being where I look at it growing up myself, if I was around a group of people, I learned pieces from things that because of their discussions themselves in an open forum. Now we don't necessarily have that. And that's where I think that we're going to be challenged with that, how do we bring it all together? Because, as we age too, having to learn new technology is kind of scary. So those are things that, we have to embrace because it's here. It's not going to change. I think that technology is great because the idea for me being an underwriter one day where I'm having to spread my own financial statements, doing everything, and now the technology can actually scan it and actually put it and start my spreading process. There's things that the busy work I don't have to do. And that's where now it's really decisioning. You have to have strong people that can make reasonable decisions, but we also have to have good policies and procedures in place for them to make good decisions. Even though the SOP and things are changing, I don't think it's anything that we can't adapt to and move quickly on. It didn't change anything dramatically, but it has to be one of those things we have to embrace what we want to be and who we are as each individual lender, and then build into that. Do I want to, as a bank too, do I spend a lot of money for technology? Technology does not come cheap. And then you've got to constantly add to it. Just because you get an LOS system or anything else that comes out of the box, there's a lot of work that comes in that I'm learning too over time. You've got to build it out. It doesn't just come all pre-populated and everything's perfect. You can get technology that creates checklists and everything based upon next codes, based upon use of proceeds, but you have to build that. Once you have it in place, then it's easier to bring in somebody and plug them into that space. But if you're trying to plug them in and you don't have your technology built right, you don't have your procedures in right, it is not going to be a good environment for anybody.
No, that's true. You guys are like so similar. Why did I have you both on? Because you're both smart. So then, in conclusion, you think that this mess, or do you think it's a mess, or do you think it's, better going back to the basics?
I'm a back to the basics guy. Lending is time tested. The more money you put into a venture, being a home or a car, the better the repayment's going to be there. The more you get back to the pragmatism, it's good. The old SOP was no change. So reverting to the new SOP, the quality of my deal will not change at all. The only thing that's changing for us at our little shop would be the sophistication of the loan operating system, and it's getting better.
Fair. Michael, what do you think?
I think part of it has to do with, going back to the fact that we're just kind of going back to the way we've done things. It depends upon the size of your shop and the type of shop, because one of the things you're going to change with this SOP was how you did underwrite, how you did close transactions. You're going to have to change your policies, your procedures. So you got to retrain, that kind of stuff. It's nothing bad, but there's going to be a gap in here because we're doing it quickly. Think about this information just came out, and by, at the end of this month, it all changes. And are you and your policy built and adapting to that? Did you already have the guardrails, or these changes may have an impact upon how you wrote your credit policy? Because from that perspective, I think can slow things down, because people's mindsets are, well, I could do this. Now I've got to go back and, well, no, I can't do that. I can only do this. But, it's as simple as, 100% ownership by a U.S. citizen or a legal permanent resident. Did you miss that? And that's one thing. You're working with a client, you forgot, oh, I need to take that person out, and I need to, change that or ask certain questions, that we didn't really think about before. So it's just simple things. It's nothing dramatic, but it's you're still pivoting no matter how you want to look at it. You're changing.
Michael, we have 3 weeks left for the new SOP to kick in. Will you refinance my MCA debt now?
It's case by case. I've always been very cautious about MCA, because it's one of those things where I think, people debt stack is what the word would be. And people go back to the easy things. And so if they're out there acquiring more, the risk is that even if you refinance them, are they going to put themselves back in that problem again? You need to know your client. That's just the reality of it.
That never changes. Like what both of you just said in conclusion, Michael, you just said it. It's not a big change. It's just a little adjustment. It's like going in a car and you have a flat tire, and then you have to change the flat tire. It's always a knowledge. It's always something.
Mm-hmm.
Fair.
Yep.
I love
No,
it.
this is exciting time. So, it's up to us to adapt and jump into this and do what we're required to do. And, I think we as an industry are adaptable. We've seen it. We've seen the changes. It's just one more little opportunity. But, it's those of us that jump a hold of this and get out there as salespeople too, and we make calls and find the right clients, we're going to be successful. Those that complain about it, you're going to have a hard time. We just need to move forward. No question.
Awesome. Raph?
All good. You did a great job.
Thank you guys for being on this with me, and I hope I made sense at some of those things, but I really love doing this though. I cannoned before, but no. Oh, sorry. Anyway.
Who's cleaning that up?
That's
I'm
right.
cleaning late today. Oh, I'm not cleaning late. I'm not gonna do it. I'm stupid. I loved having you guys on. You guys are great. Thank you.
Thank you.
Thank you, Michael.
Thanks, guys.
Appreciate you guys. Thanks.
Bye.